You're listening to The Weekly Edge, your straight-talking guide from industry experts on what's really moving the fixed income markets, here in Australia and around the globe. Brought to you by Gilt Investments. The Weekly Edge is your go-to podcast for sharp, actionable insights into the forces driving bond markets. Each week, your hosts Alastair Healey and Richard Brennan take you on a fun and insightful romp through the financial markets. With their no-nonsense style and deep experience, they help you cut through the noise. Alastair's deep market smarts and Rich's trend-driven mindset make for the kind of conversation that keeps investors sharp, and always one step ahead. Quick hits, smart takes, real perspective. Let's dive in.
G'day, and welcome back to the Weekly Edge. It's Thursday, May the 8th, and if last week's market mood was confusion, this week's theme is denial. The markets are shrugging like it's all fine. Meanwhile, the data's going dark in China, the world's in another debt spiral, and the US dollar's wandering around like it forgot where it lives. So, Al, how are you this morning? Have we finally reached peak weirdness, or is there more to come?
Richo, how are you? I'm fantastic, mate. And I don't think we've ever been out of peak weirdness. I think it's been peak weirdness since I've been in this market. It's never stopped changing, and now we're just in another phase. So I agree. It just continues, really. If you look at the market, it really is just still scrambling because we're going to another completely different platform, which we've said really in the last, say, 3 or 4 podcasts that when you go from an open environment, free trade zones to tariffs, and not just tariffs, mate. We're talking 140% tariffs. So this is high tariff, politically, targeted tariffs. So it's completely a different regime altogether, and you got to adjust. And that's what the market's doing. It's scrambling, trying to work out where the hell it can get good returns without taking too much risks. At the same time, not really knowing at this stage, where the effect's going to be, what is actually going to be the outcome after all this. Because if you think about it, you've got the biggest manufacturing country in the world, which is China, and the biggest consuming country in the world, which is the US. And the US has now put tariffs on all Chinese products. I mean, if that doesn't take the world down, I don't know what will. So, then you add to that confusion or lunacy, which is why everyone is scrambling. Europe is struggling as well. Then Europe is going to get its fair share of tariffs put on it. And collectively, Europe is bigger than China. So you're talking about a fair chunk of the, global economy, really, and transactional and just economics. It's huge. So and that's why, I know we're going to talk about this later on a little bit, is the, debt levels. People are quickly scrambling, people are quickly sort of buying in stuff before the tariffs are put on them and all that sort of stuff. So, yes, it peak weirdness.
So, listeners, grab your coffee. It's now time to dig into this week's Global Financial Funhouse. So, Al, let's start with China. They're not just having a rough patch, they're actively hiding the bruises. The Wall Street Journal reported this week that Beijing is now withholding hundreds of key economic indicators, from youth unemployment and land sales to soy sauce production. Factories are shutting down, export orders are collapsing, and youth unemployment, well, that was last seen at 22%, and then it magically disappeared from the official reports. Why? Because you can't lose if you don't keep score?
Yeah, I mean, absolutely, that is spot on. And I think that's the agenda, or been the agenda a little bit from China from day one. The problem, and I've said it many times, and it's not that I'm trying to gang up on China, but at the end of the day, they are a regime and we live in a democratic world. So they can get away with a hell of a lot more than we can get away with, and they can run their economies exactly how they see fit, and there's no opposition. So if they choose to sort of, adjust the figure, that's a little bit, not it's not quite reality, then that's completely their choice, and they've got no opposition to sort of sign off on. So that really has been a problem. So, and if you've got an economy like China now that's the biggest manufacturing country in the world, and there's all sorts of discussions and arguments that you could bring out as to how they got there and the sheer size of the place. And then suddenly, you know, the biggest consuming economy in the world says, right, we're putting tariffs on everything. You know, we've had enough of this one-sided argument all the time. We keep buying your stuff and you're not buying much of ours. So tariffs are going on. So, you know, from the biggest manufacturing economy in the world, when that happens, then you've got to scramble. And that's what's going on. You know, they've only got three choices. They can either shut their factories, they can stockpile, or find other markets, really. Shutting factories seems to be, you know, something they can't do because they're so big and they've already got unemployment, and it's quite high in some sectors over there. So they've got to keep feeding people. They've got to keep their people active, because one of the things that the Chinese government is worried about is civil unrest. So they're not going to turn factories off, which means really they're going to stockpile and then look for other markets. But therein lies the problem. If you stockpile, then you're going to cop grief from everyone because you're just dumping cheap products on there, you know, everywhere. You can see, you know, the electric vehicles in Australia at the moment. Suddenly you see them everywhere because that's probably an indication of, you know, cheap stuff that's been stockpiled in China and they're trying to get rid of it. Finding new markets, definitely. But I think most of the other markets that were available, they've already got. So, and those markets are quite small, nowhere near as big as trying to, you know, the largest consuming economy in the world has now put 145% or 143% tariffs on all their products. That's an insurmountable mountain. They can't climb over that. They can't find other markets that are going to be as big. They can scramble and try and, you know, find people to buy more stuff. So they're stockpiling everything right across the board. You know, from Australia's point of view, they've got way too much steel manufactured. They've stockpiled iron ore, stockpiled coal. So that potentially down the track could be a massive problem for us. So in that environment, going back to the original point about fudging the figures, you know, the temptation's there. They don't want anyone to know that they're in trouble, or if they are in trouble, or any of that. So the temptation, they already sort of a little bit grey on their figures. So now when they've got, you know, problems emerging and big problems emerging for them to solve and find, the temptation to water down their figures or fudge the figures or just simply not report them is huge. And obviously, from what we've just, you know, said, they are doing it. So they're not telling people exactly how many people are unemployed. They're not, you know, they've just stopped reporting as opposed to lying, I guess. Yeah, so big issue.
All right. Well, let's move on. Now let's talk about the world's biggest balloon, global debt, now pushing 324 trillion. You heard it right, listeners. Let's just say that again. 324 trillion, up another 7.5 trillion in just 3 months. Emerging markets have 7 trillion in redemptions due by year end. Developed markets, try 19 trillion. So we're now borrowing money to pay off borrowed money, to delay defaulting on previously borrowed money. Is that how you see it, Al?
Absolutely. I've been prattling on about the debt levels globally for a long time. And the thing, as putting on my ex-banker hat, you know, debt doesn't go away until you deal with it. It just compounds. So those levels are massive. The debt to GDP figure, I think you and I worked it out the other day, is something like 300% globally. So, you know, that's a massive, massive, massive pile of debt, not just with America, but with everybody. And that the American debt is the reason why we're now in this problem with tariffs. So, and it's not just them. Every country that I can see, I put it in my newsletter the other day, something like 92 of the 168 countries that are on the Trade Economics website that I look at, 92 of 168 have debt to GDP figure bigger than 50%. It's the top 20, I think there's at least 8 of them that are around, you know, 150 to 300% sort of deal. China, depending on how you look at it, has got massive debt. And so the two biggest economies who are now headbutting have got massive amounts of debt, and they're all saying we're heading towards a recession, we should drop rates. So that's just a massive issue, because if we head towards a recession, that in essence is like people losing their job. And if you lose your job, you can't service your debt. So going towards a recession is not a good option when you've got so much debt, because you've still got to service it. You can kick the ball down the road. You can reschedule the, make it a 30-year loan instead of from a 15-year loan, and you can tweak it and tinker with it to ease the pain. But bottom line, it doesn't go away.
Yeah, eventually you've got to pay the piper.
Exactly, absolutely. So, like you said, you can do what China's doing, and if you got no figures, then what was your quote you made?
And let's not forget the irony. So rates might be peaking just as credit is cracking. So the squeeze is on. So in the UK, we saw a last-minute stampede as borrowers rushed to beat new taxes. Mortgage borrowing in March spiked by almost $10 billion. Looks like the housing market's having one last hurrah before policy pulls the rug.
Yes. Yeah, I look, that to me just doesn't make any sense. That to me highlights the fact that people have never been, the large majority of the economy now, and governments and people in senior management haven't been through a correction. When you've got obscene amounts of debt around the world, and your answer to that is quickly go and borrow some more and buy housing. And housing globally, anywhere you care to mention, is overvalued. So it just doesn't make any sense. So, if you have a lot of debt, you're not lowering the risk, you're increasing the risk. And if you default, the rate goes up. And if the risk goes up, the rate goes up. So we're going the wrong way. We need to be bringing those debt levels down. The world is highly geared, which will increase the volatility as this market scrambles. As they move money around between currencies, and they move it around between countries and move it around between products, you go from a country that's doing well, but suddenly all the money drains out, so they're doing really badly, to a country that, might be doing badly, that suddenly flares up because all the money's heading over there. So this volume of money is influencing everything. Things are not being done based on good value. People aren't buying shares because the value, the price represents really good value and the company's doing well. Prices are going up purely because the sheer volume of money that's going in to buy the shares, not on the company's performance generally. And that's the same as countries, the currencies are moving around because of all that. It's a moving feast. Money moves around, and it increases the risk in some cases, and then it lowers the risk in other cases. And the Fed, reserve banks globally are the ones that have to keep an eye on that, and they have to do, the right thing. They've got to look at inflation, and they've got to look at unemployment. So in an environment where you've got this humongous bucket load of money in funds management that's whipping around the world, affecting all the currencies, affecting all the interest rates, and affecting everything. And then they've got to adjust their policy. On top of that, they're copying immense amount of pressure from media and conflicted banks and career-minded politicians who don't really care, just want to get back in again. So they put immense pressure on the reserve banks to capitulate and cave and bring rates down.
So meanwhile in the US, the Fed's playing it cool, but job growth is slowing and stocks are wobbling. So we saw the S&P snap its longest winning streak in 2 decades. And in Tel Aviv, flights are grounded amid a Yemeni aerial blockade, escalating geopolitical risks in the Middle East.
I guess there's always a catch-22 with all this as well. Whilst the Fed is, the media says it's playing cool, and jobs will bounce around because of that volume of money that's bouncing around, and currencies will move around, and there's still residual contracts that are probably flowing through with all the tariffs and stuff. So in that environment, the reserve banks have got to adjust, and it's always a bit of a catch-22 because tariffs are going to push prices up, which is going to be inflationary, and that's what the Fed has said. And they didn't push their rates down last night because they're worried that tariffs are going to be inflationary. And if inflation comes along, then you're going to have to push interest rates up. no problems. But for the catch-22 from a Reserve Bank's point of view, if they push interest rates up to control inflation, then they know really unemployment's going to go up because you're going to push the economy towards, say, a recession. So it's a real balancing act and a catch-22. So I think, the old saying in the financial markets is when in doubt, stay out, So I think that's what the Reserve Banks are going to do. And I think the RBA here will do the same. It'll sit on its hands until it's got a clear vision of what's going on. And right now, there's no clear vision. As you just said, the wars are still going. We've now got Pakistan and India fighting each other. The Middle East is still there. Putin's still making all these, ratbag, stupid politics. He's just trying to divert everything, and everyone, analyzes it and tries to work out why. And they're trying to blame NATO, and they're trying to. But at the end of the day, you've got a ratbag that just is attacked country for no reason. So how do you deal with that with interest rates and the flow of money and trying to get a return in this sort of environment?
So look, back home in Australia, things still feel relatively calm. Bond yields holding around 4.3%. The ASX isn't partying, but it's not panicking either. But there's noise about losing our AAA rating. And let's be honest, if that happens, the cost of offshore borrowing goes up and fast.
Mate, absolutely. That right there is the biggest problem Australia's got. We have, I think, shot ourselves in the foot in a big way. I think we've cornered ourselves and we've made ourselves vulnerable, in reality out of stupidity. There are some big hurdles and waves, tsunamis coming at us. We're still a small country. We're a minnow in the scheme of things. So nothing will happen to us until the offshore people start to look for money, and they'll say, where are we going to get our money from? Australia has got, we're in there with the best of them. Our debt to GDP, our household debt to GDP is, I think, the highest, or at least in the top 3% globally. It's about 116% to GDP. So you throw that on top of the federal government's debt, you throw that on top of the state government debt, this country is incredibly highly geared. We've got way too much debt. And as we just spoke about earlier on, one of our biggest exporters is stockpiling everything that moves and is overproducing and over-manufacturing. So at some point, that's going to come through to us. We don't have too many forms of revenue. One of them is mining exports, and that could easily be kicked hard. So losing our credit rating, even though Albanese just dismissed it as a nonsense, is, incredibly stupid in my mind. We need that AAA rating, and I unfortunately think we're so close to losing it. We are tiptoeing on thin ice here. We lose just to as you said, it will be bad for us. If we lose our AAA rating, you go back before 2008, before the collapse, the correction in 2008, we were AAA, America was AAA. In that environment, we still had to pay 1.5% over their cash rate in order to attract money to come our way. We've got 40% of our federal government debt. In fact, I think it's higher, but I keep saying 400 billion of our $1 trillion worth of debt at federal level. I've heard actually that figure's about 800 billion. But putting that aside, 400 billion is still a lot of money. And if we lose our rating, we're going to lose that money. So if we, in order to keep that money, or a fair chunk of it, because some fund managers have a policy that says we can put 10% into AAA. So suddenly, if we're not AAA, it's mandatory for them to take it out, whether we like it or not. So in that environment, we're going to have to scramble and push our rates up in order to stop the money leaving and also attract new money. And if we go back to the last time we were on the same rating as the States, when we were AAA and they were AAA, we paid 1.5 over. So if we lose our rating, our AAA, and it goes to AA plus, puts us again in line with the US, which means we then have to pay 1.5 over. Their cash rate at the moment is 4.5. They left it at 4.5 last night because they're worried, which means our cash rate will instantly overnight probably go to 6%. And then all the rates out across the board will go up. And right now, you've got every major bank that's conflicted with their eyeballs. Everybody is saying that we've got a 3 or 4 or 5 rate cuts in front of us, and that cash rate will be 2.6 by early 2026. So I personally can't see it unless the Reserve Bank caves into all the pressure from the media and all the conflicted interests around town.
All right, let's wrap this one up. Key takeaways for this week. China's playing hide and seek with its own economy. Global debt just broke the scale. Credit risk is rising while confidence is falling. The Middle East, mortgage markets and monetary policy are all in play. And Australia, steady for now, but skating on thinner ice than we'd like. It's always great fun talking with you these weeks, Al.
Just don't have any drink before lunch. Well, we live in interesting times. You can bury your head in the sand if you want, but you're going to get clobbered if you do. You have to be ready for it. So it depends on it's the old half full, half empty sort of deal, isn't it? Like, even in the worst economic environment we've ever had, which was the Depression, we had 30% unemployment then. No one focuses on the fact that we had 70% employment. So that cash was king. So those people who were ready for the turmoil actually, did really, really well. Coles, for example, was a $1 shop, I think, in Melbourne many years back in those days. And it's now still thriving in the biggest, retailer in Australia. It started during the Depression. So for me, you've just got to be aware of these things. There's going to be opportunities that will open up. People still need food. There will still be economic activity, but it won't be like we've had for the last 20 years. You're going to have to make an adjustment. And then that's what's going to, depress everybody because they didn't keep an eye on it and they weren't ready for it. And then so you can see it already. Everyone's complaining about, groceries going up. Well, wait until groceries have gone up 3 or 4 or 5 times, unemployment's 30%, and you've got a mortgage and you just lost your job. Then you'll realize you should have been a bit more prepared. So things like China, for example, when China started, they had no debt. They've funded their entire development through borrowing money, from the Western world. And that to me is a massive problem because not only that, they're hiding their figures and they're fudging their figures. If you did that sort of thing to your own bank, you wouldn't get a loan and they would foreclose on your mortgage if you lied on your income statement. As a country, they do it and get away with it, and we've all turned a blind eye and didn't worry about it. So as a result, global debt now is just humongous. Credit risk, definitely, because I think we've taken our eye off pricing credit risk properly. All the margins have come screaming in. People are comparing convertible notes that can be written off 100% to term deposits. And they say, 6% is great because your term deposits are 4.5%. That's a nonsense. And that happens because the people who are selling the convertible notes are conflicted to the eyeballs. They've got an interest to get capital, fence-sitting capital, as cheap as possible, so they just flog it to retail clients and then compare it to term deposits. Term deposits, major banks, they've got 400 billion at zero. So if you compare it to zero, why wouldn't you buy a convertible note at 6% with no connection to the fact that you lose all your money? So all these issues, Middle East war, we don't know whether that's going to fall over. They're going to solve those issues or they keep going. Now we've got India and Pakistan. India is what's next, China and Taiwan. So all these issues are not going away. No one's solving them. So they're all huge issues. And I don't know whether Australia's ready. Your last point there, I don't think we are definitely. I think it's an understatement that we're skating on thin ice. Hold on, folks.
Yeah. Well, that's a wrap for this week from the Grumpy Old Men at Gilts. Thanks for tuning in. Stay curious, stay skeptical, and as always, watch the edges.
Absolutely. Be ready. Be prepared. It's coming, I think. The tsunami's on its way.
Cheers, Al.
Have a good one.
Thanks for tuning in to the Weekly Edge. At Gilt Investments, we're here to help you navigate the fixed income markets with clarity and confidence. As an Australian fixed income brokerage licensed to advise and deal in fixed income securities, our experienced team is ready to help you reach your investment objectives. We hope you enjoyed this week's Edge and that it helped keep you in the loop and ahead of the curve. Until next time, stay sharp, stay focused, and we'll see you on the next episode of the Weekly Edge.